The data is awful, but the market is melting up. We've got a lot to talk about. First, let's cover what we talked about on the last weekly report. I actually got an outcome that looks very similar to mine. So there's going to be a lot of confirmation bias, by the way, and me saying that this is what I think is going to be the most probable. So last week, I was talking about this. I was saying that I was expecting the market to melt up to 4,300 as a Santa rally. If you want to see me break down this charting that was done actually by the guy who taught me Elliott wave analysis, go watch last week's video. This was 6 days ago that I talked about this. Now, what I didn't expect is how fast this rip would come. This market went absolutely ballistic. Now, luckily, it was completely prepared for that. We caught most of the move. However, I didn't ride this all the way up. I said, as I usually do, that I'm taking profits before my targets. Is exactly what I did, especially because I thought we'd take some profits on the way up, and by we, I mean the market, and it did not at all. It just went straight up. I mean, if we look, our daily TTM squeeze is rolling up. We're in a bullish RSI. If we look at the weekly, we're in a bullish RSI here as well. Our RSI is about to cross our SMA, which is also very bullish, which has lots of people confused, because if you look at the economic data that came out over this past week, miss. I mean, if you are not in a recession camp right now, I think you're just in denial. Now, the market might be seeing this as a good thing because it might be anticipating a Fed pivot. Now, go watch some of my old videos on how a Fed pivot typically is not actually bullish for the market. However, the narrative that the Fed has successfully achieved a soft landing is now the dominant narrative. People think that we are in soft landing environment right now and that everything's fine. We're not going to go into a severe recession. However, I think it's important that we not only acknowledge the fact that these are misses, but a lot of them will get revised further to the downside. Don't forget the GDP was a really good number, but again, that got revised lower as well. Now, I do want to cover what we want to look for next in the market and how a lot of this is actually tied to bond market mechanics. But before we do that, I actually want to cover one of my winners that turned into a loser. These square puts I had at one point were up 60 to 80%, and I had been taking some profits, but I had continued to hold the position because overall I am weak on the consumer, and fintech already as a sector has been really weak because of all of that. I saw Square as a big loser. I had been shorting the stock. It had been working out really well, and then we got this earnings melt up. And this made me do some reevaluating because I want to know why. And I think a lot of this is shorts covering and not so much as people becoming bullish, because I think that's why I think this stock or this trade will actually pan out in the future. And I'm looking at different ways that I can continue to play this and make back some of those losses. Overall, still up on this trade because I did take profits when I had profits. And that's so key, right? And especially because, we had tons of winners over the past 2 weeks. But one of the things is that they announced $1 billion stock buyback. I think that this caused some shorts to go ahead and cover. I think this is the melt up you see. The resulting sell-off afterwards is people taking profits that were likely bag holders in the stock, because even though it was good, it wasn't great. Now, what caused me to actually do some more research though is the fact that they had guided up. Now, lots of you are going to have seen this chart before. US credit card debt is over 1 trillion. Obviously, that's awful. Obviously, it means the consumer is really weak. Or does it? Because this is just one of the pieces of the puzzle. So I started to think, well, what happens if I actually factor in inflation with this, increasing wages, and subsequently disposable personal income, which has been gradually rising? After I normalize that data set, does this mean that consumer credit debt is actually historically high? And luckily, I didn't have to do any of that because Wall Street already did it using New York Fed and BEA data. And we can see that credit card debt as a percent of disposable income is actually historically low. Now, this doesn't mean that everything's going to be fine. We've had plenty of retail companies like Target come out and talk about the decline in consumer demand, and we also have all these recessionary signals as well, a plethora of geopolitical things to worry about. But it did immediately make me think about the podcast we had with Jonah Lupton, which, by the way, how does this only have 3 views? Go check out the podcast channel, Growth and Gains Podcast, where he said that he thinks that the narrative shouldn't be higher for longer as in relation to interest rates, but stronger for longer. And especially when you look at the movements on the S&P and this massive rally, it's hard to not start to buy into that. And we see lots of people saying that, oh, it's going to go much higher. We're going to go to 460. However, I do want to remind you that just a week ago when I put this video out, no one was talking about an incoming rally. We saw what the fear and greed index showed. It was extreme fear. Everyone was positioned short, and lots of people got short squeezed hard right here. But you know where I am stronger for longer? That's in bonds, baby. We're getting all the movement we wanted. We rode out the chop, and now it's coming in nicely. We can see the RSI has now become bullish. The TTM squeeze looks like it's about to turn over. The weekly has just rolled over, heading potentially higher. The RSI is improving. We're getting higher lows. We've crossed our SMA, and I think it's time to talk about these bond market mechanics.
So the first thing I did today was look at the quarterly refunding announcement at 8:30 and found that the bonds issuance for today, for this quarter, was being kept the same. And it's all about bonds, long duration assets that the private sector has to buy. But importantly, next quarter, they're only increasing the bond supply by 10 billion. 3 months ago, when you had me on, they increased bond supply for this quarter by 160 billion, and that caused the S&P to fall 8%, 10-year yields rise 100 basis points. And so today, the supply is still heavy, but the rate of change has gone from 160 billion to only 10 billion. And asset prices have cheapened dramatically. And so given that combination of there's still plenty of supply, but less supply, and very cheap asset prices, I think assets are cheap now. And assets can rally in maybe a false dawn through year end.
So who you just heard right there is Andy Constant, who is going to be in the future a guest on the podcast, and is the CEO of DM Spring and a financial advisor. And I think his description right there was so good that I didn't even want to try to reword it. I just wanted to share the clip with you. He explained the bond market mechanics, how that relationship affects the stock market, and how that has correlated to a rally that we've been seeing right now. But like he said at the end there, I agree as well. A false dawn is occurring right now. Now, the important thing to remember with TLT is I'm not trading this as a short-term trade, and Andy, even on that video clip, is talking about the short term. The mechanics make sense for this trade, the technicals make sense for this trade, but it's a fundamental trade that I'm going for that's based more around an actual Fed pivot likely occurring in March. And I think that even though this is playing out really well right now, I am expecting some more chop. If we come down to the hour chart, it looks like some more sideways chop, maybe a slow melt up is what we're likely going to see right now. There's also some concerns about different geopolitical issues, like what's going on with the Bank of Japan causing maybe some turbulence on this trade as well. But over time, a lot of that's going to wash out, and I think the fundamentals will win here. I just want to emphasize how much time I actually have on this position, but also how this looks like one of the most clear-cut trades on the market right now. And that's why I've been talking about it so much, probably for a few months right now, how this will likely be the trade of the year next year, is to go long on these bonds. It makes sense in the mechanics, the technicals, and the fundamentals. Now, if we look at the SPY index, I do also want to emphasize, I did do some speculation on buying puts on Friday, looking for this to have a retracement. However, remember, when we're doing Elliott wave charting, this is not a game. This is not exact science, right? This is an art. So I think based on what we've seen with the market, how excitable it's been, that this could go maybe a little bit higher. And when we're looking at 375, I'm talking in a medium to long term. I'm talking over the next, of course, a few months. A move, even this move that took only a week, took me off guard. It was so fast. And because of that, I think we might be able to go a little bit higher, but I want to play this out. I probably want to give this like another week or two to play out and then reassess what the next target should be. Although I wouldn't be surprised if this ends up burning a lot of the people who FOMO'd into the market emotionally. So either way, I think right now what I want to do is I want to assess what companies are having earnings coming out. I want to reassess what's going on in the energy market. I want to continue to manage, likely just be a buyer on my TLT position, because I want to play into what seems the most obvious and what seems to be working right now. But that's going to be it for this week's report. If you enjoyed the video, please like and subscribe, ring that notification bell. It's the only bell we allow here at Nobel Trading, because we don't stop just because the market stops. We got another video coming out maybe later tonight or Monday where Monty and I are going to break down the auto industry.